Hello and welcome to a brand new show of Market Makers. Of late, foreign institutional investors have been slightly reluctant to invest into emerging markets. The China problem has clearly created some degree of flutter and chaos in emerging market allocations. The good news for us is that foreign institutional selling has subsided, but they are yet to turn net buyers. At a time when global macros are challenging, how exactly are foreign investors perceiving Indian stock markets? To discuss that and to understand that, I have with me the perfect guest who's got a pulse of both local money and global money. Shiv Puri, Managing Director with TVF Capital. Shiv, fantastic to have you back. Thank you for joining us.
Nikunj.
A lot has changed in the last 3 months. August was extremely stormy. September was extremely volatile. October so far has been solid. So how would you assess the environment?
Well, I think that, if I look at the global environment, what is becoming clear is that there's been a commodity bubble that's bursted. And the ramifications of that, I think, are probably as severe as what we saw during the dot-com bubble bust. This is a big issue that's happening globally, and it impacts everybody. So you see the ramifications of this play out, but it's not going to be a short-term issue. This is going to take some time for it to resolve. From an India standpoint, you see that India has done relatively better than most other emerging countries, in fact, against most other countries elsewhere in the world. In fact, if you look at it over even the last 3 years, the MSCI India is up some 15% in dollar terms, whereas the MSCI emerging markets is down 15% in dollar terms. So this divergence that's happening is largely because you are seeing certain things in India, especially the macro conditions that have stabilized, that have become better over the years. And for that reason, the interest level amongst foreign investors is still pretty much there. But like I said, there is this big thing that's happened globally. And I think globally investors are, waiting to see how this plays out.
The 2008 experience has taught all of us one thing, which is that it's a flat world. What happens in US will have impact on Europe and vice versa. Right now, emerging markets are in a process of getting derated, and the derating has just about started. India ultimately is part of a larger EM basket. So we may be the best one in that basket, but if the emerging market basket is contracting, I'm sure we will also feel the pain.
I think that's correct. I mean, if you look at the data that's come out of the last quarter, ETF money from India, there's been a net redemption of about $2.5 billion. So, this is something that impacts everyone. You're seeing the sovereign wealth funds in some of the Middle East countries. I mean, Saudi Arabia has gone on record to say that they've redeemed money from managers, and the newspapers were carrying numbers of 70 billion, etc. So, the ramifications that happen to capital flows because of this massive decline in commodity prices happen with a lag, and that lag is started now. And I think that impact we're going to see for quite a bit of time.
When you talk to your global clients and you serve a lot of India dedicated money, are you getting a sense that they are reluctant to invest more into India, or they are acknowledging that India is the only island of growth and they have no other option but to migrate here?
I think the one realization that a lot of foreign clients have, especially in the US, is that their idea of allocating capital, whether it was emerging markets or BRICS or all of these other terms, are really redundant, and that they shouldn't have an EM allocation. They should have a country-specific allocation. And when they do the work on a bottoms-up basis, if you look at what's happening in Brazil or Russia or China or some of these emerging markets, India really stands out. The top-down picture has come together. The concern that is there, which is with all of us as well, is the bottoms-up story still hasn't picked up. Earnings growth has still not yet picked up. We all feel that the micro and macro will come together, but on the ground, there are small changes that are happening.
So let's talk about earnings, and the initial numbers, what we've got at least for this earnings season, they are not painting a very rosy picture. For sectors where assumptions were that things would look up, which is IT, consumer names like HUL, a media company like Z, so far there is no evidence of margin expansion or growth momentum.
Yeah, I think if we talk about IT services, for example, What is happening in IT services, as we see from all of these companies, is a lot of these contracts are not all about cost cutting. These contracts are much bigger. They're getting the involvement of the chief marketing officer, even the CEO, and they want to encompass everything from digital, social, mobility, analytics. So it's a much more comprehensive deal that companies are signing with IT services providers. As a result, these deals take time to close. And so what used to happen earlier, which was a very smooth sort of quarterly business, has changed. It's lumpy. There are, one of the large IT companies that just reported a few days ago, reported deal volumes of new deals of over 900 million, which was almost 2x what they were doing in the past. They haven't come into revenue yet. But these deals are getting bigger, they're getting more complicated, and as a result, the quarters are getting a little lumpy. But on the domestic side, we're still seeing demand to be subdued, especially on the infrastructure side. There are some signs of pickup, which I want to talk about. But other than that, demand is still yet to get going.
Why is the Indian IT sector so cheap? The valuations are still in their late teens. Indian IT companies are growing. Their business is not contracting. They're generating a lot of cash, and they're also sitting on billions and dollars of cash. How come markets are not paying attention to that?
I think one of the concerns that people have in the disruption that technology is going to have is that it's going to impact every business.
Is that a valid concern?
I think it's a valid concern for most businesses, but what you have to do is divide companies that benefit from this change versus companies that could potentially get hurt. And it's hard to figure out today, but IT services, in my view, most people think is going to get hurt, which is why there is some pressure on multiples. In my view, I think IT services companies, the big companies, are amongst the biggest beneficiaries of what is going to happen in digitization.
I'm so with you. When technology migrated from mainframe to AMD, and now technology is migrating from AMD to digital, a company like TCS and Infosys, the reboot Infosys, could actually emerge as a clear winner.
I agree with you. And in our talks, when we talk to Fortune 500 companies, the CIOs there say we like to engage with maybe a small mid-sized company that specializes in the front end for us. But at the end of the day, we also know there are only a handful of global companies that we can work with because our systems and processes are quite complex. And a lot of them are, a mix and match of a lot of different systems. Now, to be able to digitize all of that, the existing IT services vendor is the best positioned to go through that. So I think there's a lot of business that has to happen there. The other thing that we're hearing is that there's a lot of talk in the market about pricing pressure and billing rates going down. Certainly happening in some of the more commoditized parts of the business. But when we look at digital, when we look at these opportunities, these are revenue generating opportunities for companies. Analyzing data, it's a revenue generating opportunity. And there we are not hearing things on pricing pressure. So I actually think when you balance the two out, pricing will also work out okay for these companies.
You've had some exposure to auto components in the past. So are you looking at reducing your exposure?
Yeah, I think auto components have an issue right now, which is a structural issue on the diesel side of it. I think there's a lot that needs to come out. We're not sure whether this technology says it's going to do what it's going to do. The environmental results are pretty bad if you look at it on without the software sort of doctoring that happened. So I think that the whole food chain out here is compromised, and one needs to be very cautious as to what's going to happen over here.
As a theme, we've discussed why you like HFC. Housing finance stocks are still growing, and now the interest rate tailwind is also with them. So do you think housing finance companies and housing finance stocks have a long way to go?
I think housing finance stocks have a very long way to go. And especially the market that focus on the non-salaried class. That market, I think, has a very long way to go. I also think that there are only going to be a few people who genuinely get it right. Others will try and grow too quickly. They'll try and build national footprints. If capital becomes available, they'll raise a lot of money and do that. But I think they are the ones that typically fall into the risk of having balance sheet issues come up. but there are certain, select regional ones that are doing it in a very systematic fashion. And the one thing I'll tell you that's happening in housing finance companies right now is, in the past, over the last 4 or 5 years, the prices were doing well. So, for example, prices were going up 8 to 10%, even in the low-mid housing segment. Volumes are growing at 12 or 14%, and so overall loan books were growing in the low 20s. You're not seeing that pricing increase happen over the last few quarters. I'd say the last 2 quarters, we are hearing from companies that there is not anything on the pricing front. So volumes need to pick up, but that is happening. We're still seeing volumes in the 20% range.
But the entire HFC space, or the home finance space, is getting competitive, or has already become competitive. Now banks are trying to enter there, NBFCs are already present, even PSU banks, they want some share of that pie. So my only challenge here is that a business which had a lot of moat around it suddenly is looking very competitive.
So a lot of the players are getting into the high ticket value items. So for example, if you look at some of the NBFCs, I mean, they're looking at 15 lakhs, 20 lakhs and above. Whereas the housing finance companies that are focused at the slightly lower ticket level, the 8 to 10 lakh level, I don't see.
Where do you get a house in India at 8 lakhs?
Well, you have to go outside of Bombay. But, in the companies that we look at, whether there's one in the West or the one in the South, the average, ticket size is about 8 to 10 lakhs.
What is your view on this urban consumption versus rural consumption debate? The naysayer would insist and argue that rural consumption will come down because monsoon has not been great, government is not really favoring some of those social schemes, urban consumption will pick up because structurally inflation is down. But what is your stand?
I think in the short term that is exactly right, because a lot of the schemes and benefits for the rural side have come off. Agricultural prices have been weak. Land sales, which used to contribute to rural wealth, is now not going in the same direction. That's there in the short term. But I think there is no government in India that can ignore the rural part of the economy not doing well, come election time. So, I think that's something that's happening in the short term. But I expect the rural growth will also pick up.
One big reset has been interest rates now, both structurally and cyclically, they will come down.
Right.
That will change the market discounting. That will have a huge advantage on consumer discretionary, on some consumption patterns. So how are you betting on this? How are you betting on this entire rate transmission theme?
So I think the biggest beneficiaries of the rate transmission theme are the private sector banks, the housing finance companies that we talked about. I still see them to be able to best capitalize at this point in the opportunity. A lot of things that's happening on the infrastructure side is actually a balance sheet recession. There's just too much debt on some of these infrastructure developers. So interest rate cuts don't work as well when there is a balance sheet recession. You need asset sales. You need liquidity to pick up dramatically. You need business to pick up dramatically. So that part of the economy is not moving because simply on the interest rate cuts.
Another very powerful theme, at least from an investor standpoint, would be how should one really bet on the consumption. The India romance is about bet on the consumption, bet on the thriving and throbbing middle class. Consumer staple stocks are already expensive.
Yeah.
So what is the best way to bet on consumption?
The best way, I think, to bet on consumption is private sector banks, because they capture everything, and a lot of the retail-oriented banks, are best positioned, whether it's housing, whether it's auto. I think they will do very well. And as we've discussed before, they are only 25% of the total credit outstanding in this country and gaining share every day. So I think at this point, that's one of the best ways to play the consumption story. The one thing on the consumption story that needs to be very careful about, especially on the durable side, is that when you're seeing the emergence of these online distribution, I would say marketplaces, it's changing business models quite dramatically. And I think the threat that they are facing is quite severe. We were talking to several of these companies, and there's a lot of disturbance that's happening in their distribution network, a lot of disturbance happening in their retail network. Their franchisees are unhappy. And so, this sort of still is going to take some time to resolve, and I don't think the valuations are really reflecting some of the challenges. Well, so if you look at even a company like Bata, I mean, not mentioning any recommendation on the company, but just my opinion, they have a franchisee model. They are primarily sold, through the retail stores.
Tier 1, Tier 2, that's the core focus area.
Tier 1, Tier 2 is their core focus areas, and this is a company that managed its business really well over the last few years in terms of cutting costs, and so its operating margins have done pretty well. But now what's happening is people are going in their store, trying the shoe and buying it online because it's 20% cheaper. Now that doesn't make the franchisees happy. The Bata site hasn't really picked up on a lot of traffic. So this is going to be a structural challenge, and what's really going to transpire out here is, I think, the strength of the brand is going to get tested in India like it's never been before. You can't say I have a great distribution network, I reach 50,000 outlets or 5,000 outlets, and therefore that's a barrier to entry. I think those barriers are not durable going forward. The strength of the brand is going to matter, and I'm not sure how many are really true brands, and so that's I think a challenge.
So idea is to really buy into companies which are either disruptive or companies which can gain market share in this disruptive environment.
That's right. Yeah. I think that
are there any innovating companies you're betting on? Are there any innovating themes you're betting on?
I don't know about innovating right now, but in the consumer space, I think what we're looking at is anything that is used by you on the body, if it has been sort of a pattern that you've had for a long period of time. Those are still habits that will not change very quickly, even if the distribution mechanism on that changes. Now, some of these companies that don't have the reach but have a good brand will actually benefit from this, because they will see their distribution reach pick up dramatically. So what one really has to do the work on is, where does the strength of this company lie? Is it in the product? Do they just have a great product and a great brand and people want this? Or is it because they had shelf space or a retail network or distribution? Because if it's the latter, I think that's when they're going to get really tested in the years to come.
In the last 6 months, the world has taken a completely 180-degree turn. Opinion has changed, opinion has been challenged, but yes, we are adjusting to a new normal. So in terms of a very basic portfolio strategy, have your top positions changed dramatically in the last 6 months?
No, there's nothing that's very dramatic that's happening. I think
excepting auto ancillary.
Excepting auto ancillary. There is if you look at it on the last 6 months, the main thing that's happened globally is that the price decline in commodity prices have become more steep. So things have moved down further.
Okay.
Now, if you're not really invested in the commodity space or in commodity companies, that doesn't really impact that much. I'd say that there is the interest rate decline beneficiaries, which we've talked about, is something that's interesting, and that's probably something that can still be scaled up at these levels.
We've seen a tickle in the commodity space. Oil is up 25-30% from the recent low. Most of the major oil companies or metal companies globally and locally, they are up by about 15 to 20%. Big bargains are made when you just buy fear and when you sell greed. There is a lot of fear in commodities. As a long-term investor, is it time to perhaps spot some bargains there? They may not be great investment bets, but are they good trading bets?
That's hard to say, because that's not an area of expertise that I have. I can just say
that you don't own metal stocks and you have no plans to buy metal stocks.
We don't look at that space at all.
Even oil, for that matter, OMCs?
Yes, that's an area we just haven't looked at.
But Indian oil companies could have a brighter future, because now suddenly that business is not deregulated. The return ratios which you always allude to, which you always look at, they could expand exponentially and they could be bringing in fresh capacity.
It could be, but it's an area where there is still immense amount of government regulation that plays a big role in the value creation of these companies, and we typically try and stay away from.
So you don't own PSU stocks?
We're not involved in any of them, no.
But even the private PSU banks are so cheap?
So I think one of the issues that PSU banks have today is not only the balance sheet, which we all know about, but the structural change that's happening with technology, which we talked about earlier, is a lot of the PSU banks are very far behind on this. And I think if you look at the millennials, if you look at the youth out here, They are not looking to go into branches, and they're not looking to.
They may never go to a branch also.
Absolutely. So the whole sort of digital trend that is on its way. I think a lot of the PSU banks are very far behind that, and that's only going to accelerate going forward. I was hoping that there would be more fresh sort of talent that was going to be attracted to the senior levels of the PSU banks, but there hasn't been a whole lot that's happened on that front. So I think some of these big changes are structural in nature, and the capital infusions that have happened in these PSU banks are nowhere sufficient for them to begin to grow. For that reason, I think they still remain challenged. Now, of course, the prices have corrected a lot. Book value estimates have been adjusted downwards. At some point, the prices will get reasonable, but I don't think this is the time still to look at them around right now.
So when do you think the big move, the potential 15-20% move in markets could come?
I'd say that at this point, the markets are waiting for earnings to catch up. Okay. And for earnings to catch up, you need something to happen in the infrastructure side of the economy, the investment side of the economy, whether it's manufacturing or infrastructure. Something has to start happening out there. There are some green shoots. You're seeing, government spending in the last 6 months that's up a fair amount. You're seeing, the roads. There's about 4,500 kilometers of roads that have been awarded in the last 6 months. Which is more than all of last year.
Of course.
You're seeing, coal production up, electricity production up. Hopefully, these state electricity board, I call it reforms, if you will, might help that part of the economy. So you're seeing some of these signs. But in my view, fiscal 16 is probably a time where you are sort of just trying to unclog the system, if you will, and see, maybe a trickling of orders. Probably fiscal 17 is when you see, order activity pick up in a material manner. And in my view, it's going to be fiscal 18 where you start seeing all of this come into the P&L of companies. And so in my view, maybe 6 to 12 months from now, because markets are a little forward-looking, is when you start seeing, them getting priced in. Of course, the markets can fluctuate, multiples can move up. As we've talked about, interest rates are going down, which basically corresponds to higher multiples. Yes. So that can happen. But on a fundamental basis, I think you're going to have to see this pick up in the investment side of the economy before earnings come through for corporates.
So let me get a closing comment from you. What started in May 2014 as a Modi bull market, is that Modi bull market still intact?
I'd say it's the investor expectations have become much more realistic. So that I think is a good sign, because the initial phase was that of overexcitement. But if you ask me, is it intact? I think it's absolutely intact. There are some global tremors that are happening that we've talked about, which have an impact on both sentiment and valuations. But I will yet to see in India where the macro conditions improve and stay good and the micro never picks up. It hasn't happened. So
it could be a lag effect, but earnings recovery is coming. That is important.
That is correct.
So trajectory is headed higher. We may see aberrations, but ultimately it's the destination what you should focus on.
It is a destination, and if you have a scenario where there are few options globally to allocate capital, then the global allocators have more patience. They're willing to wait a little longer. And if in times when there is some volatility, you have domestic capital that is there, then I think the downside should be fairly limited.
That's a great point. That world is, there's a lot of liquidity floating around, and we are not competing for capital.
That's right.
We are the natural destination for capital. Really appreciate your time. Glad you could join us.
Thanks, Nikunj.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.